Good morning, everybody. Hope you're all doing well. And we've got lots of tax information, so we're going to get started on this. This is one we really enjoy because we can't use the word guarantee too much, but in this one we get to do it because you're guaranteed to pay taxes and you're guaranteed to die. That's the two things that we're guaranteed of. And we'll talk about the first one, taxes and tax planning. So Christian, I'll let you go through the disclaimer and read the compliance regulations.
Thanks, Derek. So yeah, just a few housekeeping notes at the beginning. Once again, for those who are on our last webinar, you may recognize this. This material is provided for educational purposes only and is subject to change without notice. Every effort has been made to compile this material from reliable sources. However, no warranty can be made as to its accuracy or completeness. Before acting on any of this information, please make sure to see a professional tax advisor for individual financial advice based on your personal circumstances. Okay, so now that we have that out of the way, today's agenda is all tax related matters. So we'll go a little bit behind into the history of our tax system and how it works. We'll go through income tax in Ontario, so the federal and provincial tax rates, a bit about the background behind tax deductions, tax credits, and how they work, explaining net income and taxable income to help differentiate those, looking at taxation of investment income, so how the different forms of income are taxed. And then finally, we'll get into a bit more on the tax planning side, looking at the 4 Ds of tax planning and our year-end tax optimization process. All right, so to get started, Canada's tax system. So originally, our income taxes were actually created in World War I to fund the war effort. So this was a 10-page document known as the Income War Tax Act of 1917. And since then, the government has dropped the word war, and we now have a 3,300-page document known as the Income Tax Act. So you can see over the years, there's been a significant amount of taxes and tax regulations added since the original regulations were passed over 100 years ago. So our tax system is a progressive tax system. So what that means is you pay more if you earn more. It's pretty simple understanding. The rates are divided into what's known as tax brackets. So depending on how much income you have, you'll fall into a certain tax bracket, which will determine how much tax you pay at that level of income. And once, like we mentioned earlier, there's 2 layers to taxes. There's both federal taxes and provincial taxes. So as I mentioned, there's the tax brackets and the separate provincial and federal. So calculating your taxes, it's a really simple formula. You take your total income, so all of the gross income you make, and then you take out some deductions, which gives you your net income. And then you take your net income, you take out some more deductions, we'll get into the difference later, and you get your taxable income. You take your taxable income, you multiply that by your average tax rate, and you get your tax payable, or how much tax you owe. You then take your tax payable and you subtract any tax credits. So this would be from various credits offered or credits you receive from taxes that were deducted off paychecks or another source. And then when you file your taxes, you get your tax due or your tax refund. There's a lot there, so we'll get into the details of each of these different stages in a bit, but that's a general understanding of how taxes are calculated. So Derek, did you want to explain a bit on marginal and average tax rates?
Sure, we'll go through this. We'll provide some specific examples as we go through this, but the marginal tax rate is the amount of tax you would pay on the next dollar that you earn. And your average tax rate is the total taxes that you pay divided by the total income, or as a percentage of your total income. And so here's where we get into some differences, because there's different levels, as we talked about the different brackets. And so I think there's a graph that should come up here, and it'll just give you a very simple example. You're at different tax brackets as you flow through. You can see all of a sudden it jumps up. So your marginal tax bracket jumps up at very specific points in time, whereas the average tax is more of a gradual slope. So let's take a look at an example. So here are the current federal and provincial brackets. And so we have to pay both sets of taxes. So just as a simple example here, if you take a look at the top line from Ontario, 44,700 is the top end of the lowest tax bracket. And the second line on the federal, 48,000 is the top end of the lowest. So if you've got around $45,000 worth of income, your marginal tax bracket is 20%. So let's go a little further. So we'll let Christian walk you through an example because he's much closer to this age than I am.
Okay, so we're going to take an example here to just illustrate how that all works. So we're going to look at Carrie here. She's 35, single, and she makes $50,000 in a salary every year. So when we look at the combined tax rates at $50,000 of employment income, you can see the combined brackets on the left here and the different rates as we go up the tax brackets. So you can see any dollar of income between 0 and this 13,229 here, there's 0 tax. Then every dollar between 13,230 and 15,714, you pay 15%, and so on and so forth. So what that actually looks like is you can see here's the different amounts of income within each bracket. And then here's the amount of tax paid on that income. So you can see what we would essentially do is take, for this bracket here, we would take this 15% tax rate, multiply by about 2,500 or the amount of income that falls within the bracket, and that gets us our tax payable. And as you can see, as you go down the chart, that's how the formula applies all the way across. And then you get your total tax payable of about 7,800 and what we would say is our average tax rate of about 15.6%. So those are the difference between the marginal rates up here and what your average tax rate actually looks like. Derek, anything to add on that?
No, just I guess the one point is that and we'll get into this later with the deductions, but you see in Carrie's top tax bracket of the 29.65%, she only has $1,464. So as we talk about deductions, if we can get her income reduced by $1,464, that's her maximum tax savings. Then she drops into a lower tax bracket. So let's carry on.
Just one important note, Derek, I have a little note here. You may notice that this right here, the tax rate jumps to 25% and then goes back down to 20. There is a special tax reduction in the province of Ontario. There you can see the note at the bottom. So there is a bit of a reduction in the taxes at that rate. That's why you can see there's a bit of it doesn't exactly follow in a linear fashion. So that's just a little explanation as to why that was not a typo there. That's actually how the tax brackets fall. All right, so Derek, did you want to take us through tax deductions?
Sure. So just sort of carrying on from what we talked about, a deduction reduces your taxable income. So tax savings are based on your marginal rate. So the higher the income you have, the more tax savings because you're in a higher marginal rate. RRSP contributions are one of the most common deductions that people are familiar with. Registered pension plan contributions, if you're working and are fortunate enough to have a pension plan that you contribute to, certain childcare expenses, and so on. So these are things that come right off, and the more money you make or the higher tax bracket you're in, the more tax savings they are. So let's take a look at Carrie again. And as we'd mentioned, she's a $50,000 income, her RSP contribution of $1,000. Her taxable income now drops to $49,000. Her marginal tax rate, if you remember from the previous slide, she had $1,464 at the top tax bracket. So she's going to get full tax savings on that $1,000 at her marginal tax bracket. So her tax payable, $74.96, and she's saving exactly what her marginal tax rate is, $296.50, or almost $300. So we take a look at Brian, who is unfortunately earning a little less money. He's only $35,000. And so he gets a $1,000 contribution. He gets a deduction, so he's only paying tax on $34,000. Now, because he's in a lower tax bracket, he's only saving 20%. So his tax payable does go down to $4,288, but his tax savings are only $200. And that doesn't seem fair because the old saying, you know, the more you have, the more you get. Well, in the case of tax deductions, that's true. The higher the tax bracket, the bigger the saving. So the government has considered this, and they have provided credits, which we'll get into some examples of now, and I'll let Christian take over from here.
Thanks, Derek. Yeah, that's a great example as to why there's a bit of what we would say unfairness in the system. And that's why a lot of the time deductions, especially one of the most common ones, RSP deductions, are based on your income up into a certain limit. So it's generally 18% of your taxable income with some adjustments made in special circumstances. So they do set some limits every year so that those who earn more do get to benefit more from these deductions, but don't necessarily get a substantially higher benefit. And like Derek said, the government has taken this into considerations and created tax credits. So the difference with tax credits is they actually reduce your tax payable. So instead of reducing the amount of income you pay tax on, they actually reduce the amount of tax that you pay at the end of the calculation. So the tax savings are based on the lowest federal or provincial tax rate, and we'll get into how this works in a second. But this just basically means that everyone benefits the same from a tax credit. There are refundable and non-refundable tax credits. So the difference between these two is a non-refundable tax credit will only reduce your tax payable to zero. It won't create a tax refund unless other than any tax you already paid. So if you paid $1,000 in taxes off your paycheck, your employer withhold that, they'll refund you that $1,000, but they won't refund you anything for tax you haven't already paid. Whereas a refundable credit, many of you may have noticed this on your 2019 returns, like the climate action incentive will actually be refunded to you even if you didn't pay any tax. So looking at a few different examples, we have our basic personal amount. So this is a standard credit that everybody receives. It allows you to earn about $13,000 of taxable income without paying any tax. There's an age credit, which varies depending on your age. Pension credits. So if you receive any sort of pension income, like a defined benefit employer pension or any RIF income, when you're over 65, you'll get a $2,000 credit for pension income. And then, like I mentioned earlier, the climate action incentive. So these are some of the different examples, and let's take a look at an example of how that actually works. So, but before I go into the example, Derek, do you have anything to add on tax credits?
No, just the age credit, really the only one that comes in there is when you turn 65. So there are some benefits to becoming a senior, and that's one of them. So let's carry on the example that we've got here of Carrie and doing the tax credit.
So Carrie gets a $1,000 federal tax credit. The lowest federal tax rate is 15%. Her income, once again, is $50,000. Her tax payable was $7,800. Her tax credit gives her about $150 in tax savings. And so her tax due is about $7,650. So once again, pretty straightforward, 15% of $1,000, $150 in tax savings. Now looking at Brian, he gets the same tax credit and the lowest federal rate remains the same because it's the lowest rate. Once again, his income is $35,000. His tax payable was about $4,500. He receives the same $150 benefit as Carrie got, despite having different income. So you can see his tax payable or his tax due is now $150 less. So this is how tax credits kind of even the playing field and allow the government to offer benefits to everybody, where those with higher income won't disproportionately benefit from that. Derek, anything to add on that example before we move on to a bit of a unique tax credit?
No, that's a great summary. And again, it doesn't matter if you make $20,000 or in the lowest tax bracket, or you make $1 million, the tax credit applies the same across the board. So that's a very fair or equal type of way that the government has of applying some basic benefits to everybody across the board. No advantage to those in higher income brackets. So,
All right, Derek. So why don't you take us through a special tax credit with
Okay.
charitable contributions?
Right. This is a very special tax credit because the first $200 you receive the 15% credit. So you just like all the other credits, but on the first $200 worth of donations. However, any donations in excess of $200 receive a 29% tax credit. So that's like going up into basically a 40+% tax bracket if you're looking at a deduction. So here's where people with lower incomes that aren't in a high tax bracket, if they donate some money, they can actually get the equivalent of like a 43 or 45% tax savings that would be equivalent of somebody putting into an RSP that's in a much higher tax bracket. If your income, and don't we all wish we were there, was over $200,000 a year, you can actually get a 33% tax credit on some donations above a certain amount. So the government has set a limit on this that 75% of your net income in any one year can be claimed as donations. There's very precious few people that ever get to that point where they're contributing that much. That's sort of the wealthy barber in reverse. Instead of giving away 10% and living on 90%, here you give away 90% and live on 10. That again would be a wonderful place to be. There is one exception to this as well. In the year of death, the taxpayer can use up to 100% of net income to offset income taxes completely. And again, if you've got a large estate, and depending on the situation, things like RSPs or RIF become fully taxable. Using charitable donations could offset a huge amount of tax, but not be that much really out of your pocket. The only one that would miss out would be CRA. And not too many people would shed a tear for that. So anything else on that, Christian?
No, Derek, you nailed it. That's pretty much a great summary of charitable contributions and how they differ from some other tax credits. So we've used a few different terms here that I want to go into and explain a little more with net income and taxable income. So you may remember the formula, and there is a bit of a difference between the two, and we'll go through a bit now as to why that exists. So net income is what's used to determine your eligibility for what's known as income tested benefits. So a great example of this would be old age security. So this is a benefit you get from the government that as long as you've been in Canada as a Canadian resident for over 40 years, you get old age security. However, after a certain point of income, you will get it clawed back. So if you make more than a certain amount, the government will say, okay, you are okay on your own. You don't need this extra benefit. So we're going to take a little bit back. So this is what the government does to account for this. They differentiate between your net income and your taxable income. Your taxable income is what they use to calculate your income taxes. And the reason that for the differentiation between the two is that some income, while it's not taxable, is considered when applying for these social benefits. A great example of this is workers' compensation benefits. So the government wants to take these into account when looking at how much old age security or other income tested benefits they provide you, but this, you don't pay tax on that income, on that workers' compensation benefit. So what they do is it shows up as part of your net income, and then you get a deduction from your net income. That's why there's the two different layers. There's deduction from total income and deduction from net income, so that you don't end up actually paying tax on that income. However, they'll still be able to see it when they're looking at how much old age security or other benefits to provide you. So that's the difference between net and taxable income. And that's why there's the two and why the government has set up the system that way. Derek, anything to add on that?
Just the one thing on you mentioned the clawback of the old age security, which is quite a common question we get. So I'll try and answer it now before it comes up. First, you've got to be 65. So not everybody's there yet. But those that are over 65, we actually, much to the chagrin of our clients, we say that we're trying to get all of your old age security clawed back. And they look at us with total confounding looks and say, why would you do that? And the reason we say that is because you don't start to lose any of the old age security to claw back until about $78,000 individually of net income. And you don't lose it all until after $125,000 each. So if you can't live on $250,000 each of net income, we have a whole different problem than being concerned about paying back the old age security. But other than that, excellent job on this. So let's take a look at how other income is taxed. So that's basically for what we've talked about has been salary and so on. We're going to talk about investment income because it comes in a number of different forms and it's not all taxed the same. So the first, which is people are most commonly associated with or understand, interest income. If you had a GIC, earned a little bit of interest income, it gets taxed exactly the same rate as your salary or T4 slip, anything like that. So it's 100% taxable. Dividend income comes in a variety of forms. The main one we'll look at is eligible dividends, which would be if you own some shares of Bell Canada, Royal Bank, or whatever, and it pays a dividend out. It's considered an eligible dividend, and you pay a gross up. So if you receive a dollar's worth of dividend, you actually have to report $1.38. Now there's an offsetting dividend tax credit, so you don't owe as much. But going back to the previous point, this can cause old age security clawback because let's say that you received $10,000 worth of dividend income, you actually have to show $13,800 on your net income, which affects your OAS clawback. So if you have a whole bunch of dividend income after age 65, it could affect OAS clawback, even though you're not receiving all that much money, and you will pay less tax on it because there's a tax credit at the other end. Non-eligible dividends are from private corporations, and so there's a little less of a gross up and a little less of a tax credit. And foreign dividends, if you own shares of Walt Disney Company or something like that, unfortunately, they're from a different country, so we don't give them any benefits, and you pay tax on it just like interest income or T4 salaried income.
And then just one thing to add on the foreign tax credit or the foreign dividends is if you pay any sort of foreign withholding tax, there's typically, because we have a treaty with the US more specifically, or with a number of other countries, there may be some tax credits you receive for withholding tax. But as Derek mentioned, for foreign dividends, they're generally fully taxable with potentially some offsetting benefit from foreign withholding tax.
Good point, Christian. I thought with the pandemic and all these rules, you can't travel to foreign countries, that we wouldn't be able to pass taxes back and forth. But I guess that flies under the radar of the pandemic rules. So good point. Thank you for pointing that out. The next type of investment income is capital gains. So capital gains is you buy a share for $10 a share and you sell it for $20 a share. You've got a $10 profit or capital gain. Only half of that, or 50%. So $5 of that $10 profit is what shows up as taxable income. So of course you're paying less tax. And there are some investments, mutual funds or some individual trusts and ETFs that actually pay out a return of capital. And return of capital is not taxable. It's a tax-free distribution. It's like you putting money into your bank account and drawing money out. You've already paid tax on that. It reduces the cost base. So while you can, let's say again, say you put $10,000 into something and you get $1,000 back as return of capital over the next 10 years, you've paid no tax on that because it's all been basically saying we're paying your money back. However, now if you sell it for $5,000, which in your mind is a loss because you put $10,000 in, the government's going to say, oh, your cost base is zero, so you've got to pay tax on that. So return of capital, initially, that comes out tax-free, but it reduces your cost base and will give rise to a capital gain in the future, even if the investment has gone down in value. Did I miss anything, Christian?
No, that's a great example. Return of capital is only eligible in certain investment vehicles, mainly speaking non-registered taxable investments, because there are those capital gains. So it's a very specific form of income that's used in very specific circumstances. Generally, it's used to eliminate or reduce the effect of old age security clawback or other kind of income tested benefits. So return of capital is great for those specific circumstances. However, there's very limited uses, and it has to be used very strategically to really receive that benefit. So let's take a look at an example with Carrie again to illustrate how all of these different forms of income are taxed. So there's a lot of numbers here, but if we had $50,000 of total gross income, so that means you received 50,000 of employment income, interest, eligible dividends, non-eligible dividends, a capital gain, or return of capital, here's how that pans out. So you will see the taxable income is a little bit different. So employment income and interest are, you have $50,000 of gross income, it's taxable at 50,000. However, that eligible dividend, so these are from Canadian publicly traded companies, has that 38% gross up that Derek mentioned. So you actually have to report $69,000 of taxable income. The non-eligible dividends, which come from private Canadian companies, have a slightly smaller gross up, so you're only reporting $57,500. Capital gains, which are one of our favorite, you only have to report $25,000 of taxable income because only half of a capital gain is taxable. And then finally, the return of capital, we would have $0 of taxable income because you're, like Derek said, you're essentially getting your money back. Now, when we look at how much taxes actually due, you could see that there's a lot of variation in that as well. So the employment income, we have about 7,500, and you can see the reason for that is there's some tax credits that you would get with employment income, like the Canada Employment Amount, CPP, and some other benefits that you receive. So there'd be a slightly lesser amount of tax due, whereas interest doesn't benefit from that. You can see a great example here of with eligible dividends is you only actually end up paying $600 on that $69,000 of dividends. So even though we have that gross up, which brings our taxable income higher, the offsetting dividend tax credit means we actually pay a very small amount of tax on that income. Looking at non-eligible dividends, it's the same story. So we have a slight gross up and an offsetting tax credit. So we pay less than we would with employment income or interest income. So while it's not the same benefit as eligible dividends, there are still some benefits there. Capital gains income, you can see it's essentially, we're only paying tax on 25,000, so we have a lot less tax due. And return of capital, once again, no taxable income, no tax due. So there's a lot of numbers here, but that just gives you a great overview of kind of the different forms of investment income and what the kind of implications are with each level. Derek, anything to add on the taxable income here?
Yeah, just the one point, and you've laid it out here well on the chart. If we could, to turn this into percentage, if we earn 2% on a GIC or 2% in eligible dividends or 2% in capital gains, people say, what's the difference? I'm earning 2%. Well, there's a lot of difference in how much you would get to keep of that 2%. Again, we're talking about money that's in a taxable account, not that's money that's in a TFSA or an RSP, but in money that you have to pay tax on. The type of investment income you have has a huge, huge impact on how much of it you get to keep. So let's carry on with the next one. We're talking about, I think, the 4 Ds. So Derek Dutka's double duty. Okay. First D we talked about was deductions. So we try and get deductions to reduce our taxable income. We then divide. Okay, so we're going to go through them like this. So deductions, as we talked about, the RRSPs are one of the most common ones. You can do something like a debt swap. So in an example like this, let's say that you had been working at Bell Canada, and you're part of the stock savings program, and you've got $40,000 worth of Bell shares in a taxable account. So you're paying tax on the dividends that you receive. And when you sell them, you'll pay tax on the capital gains. And you need a new car. So you borrow some money and buy the car for $40,000, and you still got these $40,000 worth of Bell shares. So now the purpose of borrowing the money was for the car, so therefore it's not a tax deduction. However, if you sold your Bell shares, got the $40,000 cash, we'll just forget the taxes for a moment, pay cash for the car, borrow the $40,000 and buy those Bell shares back again, you now borrowed the money for an investment. Therefore, all the interest on the investment loan is tax deductible. So that's what we mean by debt swaps, making your money tax efficient and reducing taxable income. Rental expenses, if you own a rental property or rent out part of your home, there's many expenses that you can write off against that. You need to, if you're not real familiar with this, you should talk to an accountant or look into it, because there's a variety of expenses that you can use to write off and reduce your taxable income from that extent. So why don't you talk about the next D?
All right, the next one is divide. So we skipped over it a little quickly, apologies for that, but the next D is divide. So this is what we're talking about with income splitting strategies. So this is dividing taxable income between multiple parties. So whether it's spouses or a number of family members within a corporation. A few examples of dividing taxable income is pension splitting. So whenever you receive pension income, so whether that's an employer pension, or any RIF income when you're over 65, you can actually split that income on paper, so on your tax return, so that between you and your spouse. So if I have $50,000 of pension income, I can actually move up to half of that to my spouse, and we can both, instead of me reporting $50,000 of income, and as you remember, we have marginal rates, so the more income you earn, the higher rate of tax you pay. So if I split that between my spouse, now all of a sudden we're only reporting 25,000 each, and we're paying much less tax on that amount. Joint ownership is another one. So when you're holding, you have to be a little bit careful with this one because there's what's known as attribution rules, which we'll touch on a little bit as there was a question that was submitted on this. We'll address later, but joint ownership is a great way of splitting income as well. So if you're buying, for instance, a second property where there's potential tax in the future when you sell it, if that property is owned jointly between two people, they can split the income. And then prescribed rate loans is another one, which work in very specific situations. What this essentially is loaning income to a spouse at a certain minimum interest. So a prescribed rate is the rate set by the government that says if you're going to loan money to anyone, you have to at least charge this amount of interest. Otherwise, it's not really a loan in their eyes. So if I were to loan money to my spouse, I would have to charge at least 1% interest on that loan. And as long as she pays me that 1% interest, then she can do whatever she wants with that money, invest it, and none of the tax gets attributed back to me, which is the attribution rules. So if you give money to somebody for the purpose of investing and making money and paying less tax, the government can say, wait, no, that was your money and you just gave it to that person to invest in their name. So we're actually going to take all of that taxable income that they earned and we're going to make you pay the tax on it at your tax rate because you just gave them the money. So that's a really brief background on prescribed rate loans. Anything to add on that, Derek?
Just the joint income one and dividing taxable income. Let's say, for example, you've got a lady that's a lawyer making $150,000 a year, and the husband has decided to stay at home and raise the kids and runs a little part-time business making $15,000 a year from home. He could actually invest $15,000 a year in his own name and avoid attribution because they would simply say, you know, she's such a lovely wife that she pays all the bills and all the expenses and allows the husband to take and invest all of his money and do whatever he wants with it. So he actually has traceable amounts that he could invest that totally in his own name. And the other thing is that in joint ownership, especially with pension splitting rules and Family Law Reform Act, in most cases, if it's not huge amounts of money, if you've got a joint bank account or some small joint investments, the government isn't going to question it too much. But if you have somebody, again, making $150,000 and all of a sudden you've got a whole bunch of investments appearing in the other person's name, or you've got many multiples of thousands of dollars in investment income being split between the two, that might raise some red flags with CRA. All right, the next D. Was there anything else on that?
No, that's it. I was about to say, Derek, why don't you take us through tax deferral strategies?
Okay. So if you can't avoid it, defer it as long as possible. Now, this is great when it comes to income tax. It's not great if you need to apologize to your wife, which I have to quite often. You want to do that as quickly as you can to get that out of the way. But when it comes to paying taxes, defer that as long as possible. So RRSPs are one of the examples that we look at because, again, theoretically, you're in your high income earning years, you're saving 30, 40, as much as 50% when you put it in. So you're getting a good deduction. You're not paying any tax on it until you take it out in your retirement. So theoretically, in your retirement, you're going to be in a lower tax bracket. So let's say that you're in the top tax bracket when you're putting away, you're saving 50% when you put it in. It now grows tax-free And when you take it out, you're only paying 25%. Not only did you save some tax, but you deferred it for many, many years. Another thing that you can do, and would be if you're selling a business or a property, you can do vendor take-back mortgages or promissory notes in the case of selling a business or something, whereby you structure that you've sold something. For example, you've sold something for $1 million, and you're going to get paid $200,000 this year, next year, the year after, up to a maximum of 5 years. You have to show the government that you've sold the property for $1 million and declare your capital gain. But then there's what they call a reserve. You say, but I only received $200,000 this year, so I get to spread out the money and pay tax on it in the year that it actually comes in. So you're much better off to, even if the $1 million was total capital gain, you pay a lot more tax on $1 million in 1 year than you do if you spread it out over 5 years. So that's a much more complex thing and not applicable to everybody, but where it can be used, it's very effective. All right, Christian, did I miss anything on that one?
No, that's perfect. I'm just going to go through the last D, which is diminishing taxable income. And what that simply means is just minimizing the amount of income you receive that is taxable or the rate at which it's taxed. So this is trying to take advantage of all the different vehicles out there to just make sure we get as much tax-free income as possible. A great example of these are tax-free savings account and registered education savings plans. So with TFSAs, any income earned inside a TFSA is tax-free. So we want to make sure that we've put as much into a tax-free savings account as possible so that any investment income earned is tax-free. If we have a portfolio with a lot of taxable investments and we have to pay tax on any interest, capital gains, and dividends, and we haven't maximized our TFSAs, we're missing out on some of the benefits we can receive. Once again, charitable contributions are another great example. Corporate class investments are, once again, another niche strategy when you have a taxable investment portfolio. Corporate class essentially structures the mutual fund as its own little corporation. So it can take in different forms of income like interest and foreign dividends that are taxed higher, write off some expenses within the corporation or within the mutual fund, and only pass along the capital gains and Canadian dividends, which are taxed a little more efficiently. So it's a certain structure of investment, which in some situations can provide a very meaningful tax benefit. However, once again, it's more of a niche situation. And then salary versus dividend planning is more for self-incorporated business owners. You can choose to take your compensation in the form of a salary or a dividend. And there's a number of different implications and a number of different factors that go into making that decision. So once again, make sure you consult a professional tax advisor when going through that decision. But that's another way you can diminish some taxable income, is finding an optimal balance between the two. Derek, anything to add on diminishing income?
No, that's good. Again, like you mentioned the RESPs, you give up the money because you're putting the money in basically in trust for your child as the beneficiary for their education. That could be as your children or it could be grandchildren. So you've given up the use of that money, but all of the money grows tax-free until they take it out, and they're not going to likely pay any tax at all on it when they take it out. So it's a lot better, and plus you get the 20% grant on the contributions you put in from the government. So it's a great way of actually increasing your rate of return and minimizing your tax or diminishing taxable income, because it's out of your hands now, it's into another person's name, another form of income splitting. So we'll walk you through an example of in-kind versus cash donations. So a lot of people make charitable contributions, whether it's to the Cancer Society, to their local church, whatever charity is near and dear to their heart. And so some people sell some investments to get cash and then write a check to the charitable institution, which is great, but it's not very tax efficient, especially if you have some investments that you've held for a long time. So we're going to run through an example here just to magnify the numbers. We're using a very high income situation, but it works just as well for people in the lower tax brackets, because if you remember, the charitable tax credit, once you give over $200, gets a real high tax credit. So you're getting the equivalent kind of tax savings as a higher income earner would. So this individual makes significant amount of money. We'd all like to be there. He's got a $100,000 mutual fund that he's now saying, I want to make, big gift to the Cancer Society of Canada or whatever. So he sells his mutual fund to make the donation, but he's got a huge capital gain on it. He's doubled his money. So he's got to report $25,000 worth of taxable income. And so at the end of the day, he ends up paying, his marginal tax bracket is 53%. So he ends up paying, the net tax savings are $35,000 when he gives them the money because of the charitable contribution. However, if he were to now, instead of cashing that mutual fund in, just sign a paper that says, here, send these shares of this mutual fund right directly to the Cancer Society and let them do whatever they want with it. First off, he doesn't have to report the capital gain at all. It never shows up. So he's got zero capital gains, so no extra tax. And what happens is that he ends up getting back an extra $12,000 in tax savings. He's given exactly the same amount of money, but he's saved $12,000 in extra money. And on a much smaller situation, we've got an example of a client right now that had inherited some shares of a financial institution many years ago. And so we're looking at it. She's got a huge capital gain. So we said, do you have a charity that you tend to favor? So what we've done is a little strategy. We said, okay, here, just for example, if you cashed it all in, you're going to end up paying a lot of tax on this. If you gift $1,000 worth to the charity directly, it's only going to cost you $300 in essence. So I said, you can cash it in and end up with $300 in your pocket, or you can donate a whole $1,000 worth to the charity, but it's really only costing you $300. So it's, again, just a choice that you can make. All right, did I miss anything on those, Christian? And I'll let you wrap up the process.
No, that was great. So this is a perfect example of making the most of the tax planning strategies we have. So the charity is still getting the same $100,000 donation, but with this example here, this gentleman was able to save an extra $12,000 in taxes just because he decided to give that donation in a different form. And one thing to note, there is no difference from the charity's perspective, because even though they're getting that $100,000 now in mutual funds and there's tax owed, charities are nonprofits and have tax exempt status. So they can cash in that $100,000 and not pay any tax on it, which is why this has become a really popular strategy. So that if you have, a large capital gain on an investment, you can give it to a charity. Charity gets the same benefit, and you get some significant additional tax savings. So now here's a little bit about our year-end tax optimization process. So in certain situations, this is what we do on an annual basis for clients to make sure we're making the most of our tax planning strategies, or the 4 Ds we talked about. So we'll make an estimate of your taxable income for the current year. We'll review your goals and expected cash flow needs. So we'll take a look at, any big expenses coming up in the next few years. How much income will we need? Where can we draw this income from? Do we have enough tax-free income or other sources that can cover these expenses? And then we'll look at, okay, how much taxable income is what we would call the optimal, which is usually around 48,000 or the top end of the lowest tax bracket, but can vary depending on your goals. We'll determine that optimal level, and we'll make some calculations to assume, okay, where is the best place to pull this from? Should we trigger additional capital gains? Should we pull more RSP or RIF income out? What other sources of income can we draw from to get us up to the top end of that low tax bracket? And then we'll provide our projections and recommended actions. So this is the process we go through with a lot of our clients to make sure we smooth out the amount of taxes you pay over the long term. The reason we do this and why we essentially say pay more tax now is because it gives you more tax efficient income for larger expenses. So this would be tax-free savings account or even money in a taxable account that just now has a smaller capital gain because we've triggered some of that income. It reduces your lifetime tax bill. So an example, we'll go through an example here on what we did for a client recently. Without our tax optimization process, that client would have paid about almost $44,000 of tax over about a 3-year period. So this includes tax on the estate because this client was a little bit older, in her 90s, and the income tax paid every single year. Now, with our tax optimization process and why this is such a benefit, you can see that she would end up paying about $32,000, so significant, about $20,000 more in extra tax over the 3 years. However, the final tax on the estate was significantly less, and the end result was about $10,000 saved in taxes. So this one can see doing this on an annual basis in this tax optimization process can have a very significant benefit for the clients where this is required. Derek, anything to add on our tax optimization process?
No, that's a great thing. We're always looking at ways, again, as Christy mentioned, if you may need a large purchase in a couple of years and don't have much in an open investment account, can we take a little extra out of your RIF and stick it into your TFSA? Because again, the whole idea is the TFSAs, we want to become our largest account because you never pay any tax on the growth or withdrawals. And we want the RIFs and RSPs to actually become the smallest accounts because we pay the most tax on those. So constantly looking for little ways that we can maybe pay a little bit now, but save much, much more later on. And that wraps us up. So let's get into some questions. There were some questions that were already sent in from some of you. And if you've got additional questions, please key them into the chat and we'll address them, as many of them as we can in the next 10 or 15 minutes. All right.
Okay, so a question, Derek, just came in, and I'll read it out for you. So given the present situation, many people may be looking at running a business from home. I understand that there are allowable house expenses that can be used to write down taxes. If a person were to sell their home, would they have to pay capital gains on the sale? So there's a number of different layers to this, Derek, but did you want to touch on this one?
Sure. Why don't you put us to the screen so they can see us a little bit better?
All right.
And, we don't need that slide there anymore. So in most cases, there wouldn't be a capital gain, but it depends on how much of the home you're using, because it really comes down to how much of the house, and this is where a good accountant comes in. I know the general rules, but those are constantly changing. And even this year, the announcement just yesterday or the day before, government is offering a $400 tax benefit, no questions asked for anybody who worked from home this year. So that's great because most people ended up working from home. So there's a little bit of a benefit. But basically it's on a percentage of the expenses. So for example, if you used 10% of your home for your business, then you would be able to write off 10% of utilities, taxes, and so on. And you can do that by square foot or by the number of rooms. So if you're using 1 room out of 10, that's 10%. If you're using 100 feet out of 1,000 square feet, again, that's 10%. So you can do it whichever way works out more beneficial for you. If there's specific expenses that you had for that, you put in a separate phone line, separate internet or whatever, you could write that entire amount off as long as it's used exclusively for the business. So this is where it gets a little tricky. And the point is that if you start running a business from home and you're constantly showing more expenses than your income, you're going to raise red flags with CRA and you're much more likely to be audited. So just need to keep very careful track of all the expenses and what they're for and how much you're using it for business versus personal. So if you open up a business and use it 1 day a week, a small closet in your house and try and write 15 or 20% of your business or of the house expenses off, not likely going to go very far if you ever get audited. Next question.
All right, so there's one that came in or that was submitted earlier talking about joint bank accounts and how they can cause problems when it comes to splitting income for tax purposes. So I can take this one, Derek. Sure. A lot of that comes back to attribution like we talked about, and consistency is another big important factor with this. So the CRA, if with a joint account, you can technically claim it in either spouse's name or you can split it. the key thing is you have to be consistent. If one year you decide to claim, if one year I say, you know what, our bank account earned a lot of interest, I'm going to claim that in my name because I made less than my wife. But next year, my wife made a little bit less, so I'm going to claim the interest in her name, and you keep flip-flopping over the years, because that's going to raise some red flags with the CRA because you're not claiming it in a consistent fashion. The other is attribution, like Derek mentioned earlier. It's not necessarily a big deal if you have 10, 15,000 in a bank account. However, if you have one spouse making $150,000 and one making 15, and you've got this joint bank account with $100,000 in it, earning a fair amount of interest, well, the CRA may look at that and say, well, this is probably the higher income spouse's income, so you can't, and they may not let you split that with the lower income spouse. There's a number of different layers to that. So once again, it's always important to consult your accountant when claiming, when splitting income and something, and make sure you address your personal situation and those details when looking at this. But I would say that's the gist of it. Derek, anything to add on that?
No, that's a good thing, and consistency really is the key. Because if not, you need to show value as to why one spouse is now taking more of the investment income versus the other one. Did they come into some money and put some extra money into the account, so now they're 2/3 or now 100%? So again, just be consistent in how you're claiming it, and that shouldn't be a problem in the future.
Okay, there's one question here that says, where can I find information online for tax requirements? Generally speaking, you can find your personal tax details on your My CRA account. So this is an account you can log in using your online banking information, and that will get you your historical tax slips, tax returns, notices of assessment, and a number of other different tax information. The CRA website also has more general tax information. The Income Tax Act is available online as well. However, unless you're in for some very heavy weekend reading, I don't recommend looking through the Income Tax Act because it's quite dense, as you mentioned. It's about 3,300 pages. But generally speaking, that's where you could find some different tax information. Okay, so there's a few questions on capital gains, which we addressed, RSP retirement income. Once again, like we mentioned, RSP income is treated as regular income. So it's fully taxable unless you're over 65 and you convert it to a RIF, then it's considered pension income. In all other situations, it's just regular income. Derek, there's one question here that says, do you think the government will change the capital gains tax regulations in the next budget?
Certainly a good possibility. There's been quite a few rumors of that, and the government keeps wanting to open up their hands and say, we've got your back because we're just giving you your money and we don't have it yet, but we'll get it eventually through taxes or if the economy improves. So the two easiest ways for them to increase taxes without causing a massive revolt are capital gains tax, because the vast majority of people have their money in RSPs or TFSAs, which are not affected by that. So this is people that have extra money, therefore considered wealthier because they've got money in a taxable investment account, and they're only paying tax on the gains they have. So this is another one of those ways the government is sort of going around by saying, we're going to tax the rich people. Now, I know many of you have open accounts and you don't consider yourself rich, but in CRA's eyes, you're considered rich. And so they figure there's an easy way to go after the rich people, is we'll raise, instead of only taxing 50%, rumors have it they'll go up as high as 75% of the capital gains would become taxable, likely to be introduced in the spring 2021 budget coming up in 3 or 4 months. The other thing would be to increase GST because that is seen more as, well, the people that buy a Ferrari or something like that and spend $100,000 on a car, certainly they should be able to afford to pay more. It's more of a user pay thing. So even though it does affect people in the lower income bracket, there's easier ways for the government to give credits up to a certain point. But this way they're, again, taxing the rich or the people that spend more money. So those are the two most likely tax options coming up in the future. So I do think capital gains is a highly likely target. Maybe it won't happen, but it might.
Okay, so there's one on the tax implications of deferring charitable donations. So the tax implications are pretty much the same with charitable donations. You don't have to claim them the year you made the donations. You can defer them. So this is beneficial if you hit that 75% sweet spot where you've maxed out your charitable donations. But generally speaking, because it's a tax credit, the implications would be the same regardless of the year you claim them in, unless you're making over $200,000 in taxable income. Then there may be a bit of a difference in the benefits depending on when you claim them. Now, you could defer them from 1 year to a year where you may have a large lump sum of taxable income coming in. That can be used as a strategy, although the benefit is pretty much the same. It does lessen the blow if you are getting something like a pension payout or some other form of lump sum one-time taxable payout. So that could lessen the blow or soften the blow, I should say, of a larger payment like that. But generally speaking, the tax savings, because it's a credit, are pretty consistent regardless of when you claim them. Derek, does that sound about right?
Yeah, just the two things to add to that is one, you've got a maximum 5 years to claim it. So let's say that you received an inheritance or won the lottery or something, and you said, hey, I'm going to donate $100,000 to charity this year. Great, because you want to do it, there's a specific need, so you donate it. But you go, oh, that's much more than I need to get my taxable income to zero. You can literally claim $20,000 a year for the next 5 years and get nice refunds from that one contribution. So that's really the two things: maximum 5 years, and I guess that's it. The 5 years is a big thing. And again, it's a non-refundable tax credit. So if you try and use it all in 1 year, actually the tax programs won't let you. They'll bring you down to zero, and then just carry it forward to the remainder into the future.
All right, so we got one more question that came in, and it's actually timing out perfectly because it's almost 12 o'clock. So this one is just someone saying that they're doing their own business taxes this year. We didn't really address much on business taxation. We would need a whole other webinar on that because it varies quite largely depending on if you're incorporated, if you're not incorporated. And generally speaking, this would be the job of an accountant to do. So we won't touch on business taxes on this webinar because there's a lot to it and a lot of different implications with business taxation, depending on how the business is set up, the forms of income, and things like that.
So the one thing I'll just add to that is that, again, depending what you mean by business income, I'm not sure who submitted the question. So if it's more like a sole proprietorship, you're in business for yourself, but you're not an incorporated company, it's literally like just your own income. All you do is you have to list all the revenues and all the expenses. So you need to, again, depending on what kind of business you're in, if you're using your vehicle, some for personal and some for business purpose, if you're using your home and so on. So there's quite a bit of detail. Now there's, again, just Googling business income or self-employed income. There's great information on the CRA website, as well as just Googling it, you'll get 3 or 4 different opinions. But there are quite a few different deductions and credits and so on that are available to businesses. Biggest thing I'd say is keep really, really good records of every mile that you drove in your vehicle for business purposes, every expense that might be related to your business and so on. And at the end of the day, if you're not quite confident in having everything, at least for the first year or two, get a professional accountant to look at it and guide you through that.
All right, so that is everything, and it's 12 o'clock, so we will not keep you any longer. Thanks everyone for joining us. And if you have any other questions, please feel free to send us an email or submit them afterwards. We will be posting a recording of these sessions to our website. So you'll be able to rewatch it because I know we covered a lot of information. There's a lot of numbers here. So you will be able to rewatch the session just to, if you want to refresh your memory.
The other thing is if you have topics that you might be interested in, we do plan on doing these on a regular basis, so we're certainly open to feedback from you as things that you'd like to hear about. So other than that, thank you so much for your attention and the questions and for listening in. We'll see you again soon, hopefully. A lot of times it's by by Zoom, so this is as close as we might get. And if we're not talking to you before, have a very Merry Christmas. Thanks a lot. We'll see
Take
you all
care.
soon.
Bye now.
Bye-bye.